Should I pay points, and what are points? These days, with interest rates moving so rapidly and house prices moving just as rapidly, many home shoppers are looking at paying points to buy their interest rate down, being fixated on the lower mortgage rate, or sometimes they have to buy the rate down by paying points simply to qualify for the loan. Points, also known as discount points, are a charge paid up front to a lender in order to lower the interest rate. Lender credits are the opposite. They're a credit towards costs with a higher interest rate. Points can be a good choice if someone knows that they're going to stay in the home or keep the loan for a long time. Paying extra money up front reduces the cost of the interest over time. Points are calculated as a percent of the loan amount. For example, a $600,000 loan, 1 point equals 1%, or $6,000. A half a point equals $3,000. Many lenders will advertise very low rates, and then in really small print, when you dig down into it, you'll see that the low rate has a cost of 2 or 3 points, which can get very expensive with large loan amounts. The total cost analysis is a fantastic way to have a clear, concise view as to the cost of a loan, a cost of different interest rate scenarios, versus trying to dig into a lender's website or looking at old school PDF fee sheets. When you're looking at a total cost analysis, in this example, we're looking at a $750,000 purchase price with a $600,000 80% loan amount. The 4.875 rate today is the par rate, meaning there are no discount points or extra charges associated with it. And we'll see the cash to close at the bottom. If we go down and pay a half a discount point or $3,000, a 0.5% of the $600,000 loan amount, we can reduce the interest rate to 4.75, reduces the payment, and increases the cash to close. Same if we pay 1 discount point or $6,000, we can reduce the interest rate, reduce the payment, but increase the cash to close. And the opposite happens with a lender credit, where we go with a higher interest rate, increasing the payment, but also decreasing cash to close. In the total cost analysis, when you click on the More Info button and go to the Closing Cost tab, you can very clearly see discount point charges associated with rate tiers, as well as lender credits associated with rate tiers. And the best thing about looking at different loan options with the total cost analysis is looking at the actual savings over time. Well, we have the payment, we know what we have the interest rates, we see the monthly savings. But if we look at it over time, then we can get a very clear comparison of, okay, the par rate versus getting a credit will save us money in the first 5 years, and paying a half a point saves us a bit more, $1,500. Paying a point saves us $2,200. And looking at it in the long term, in this case, 10 years, we can see the interest paid at the lender credit is the highest of $275,000, the par rate $268,000. Paying a half a point up front, so $3,000, saves us about $7,000 over 10 years. And paying $6,000 or 1 point in the first 10 years saves us about $15,000 over 10 years. So if you're shopping for interest rates right now, shopping for a home, be sure to ask for a total cost analysis. It's a fantastic way to compare different interest rate tiers. Don't focus on online advertisements or what you see on a PDF sheet, because it doesn't give you the true over time perspective of how much that interest rate really costs. If you'd like a total cost analysis, give me a shout. I'd be happy to put one together for you.